Thank you, Mr. Chairman. I have a number of questions, and I know I'm not going to get to go through them all during the hearing. And so, although I'm going to ask each of the individual nominees for the Federal Reserve a question, I'm also going to ask the other nominees who don't get asked that question to respond to it later. So I just alert you to that. The first one, I will start with you, Mr. Fischer, is a recent paper presented at the U.S. Monetary Policy Forum suggests the possibility that the current monetary stimulus may involve a, quote, trade-off between more stimulus today at the expense of a more challenging and disruptive policy exit in the future. Do you agree with that? And if you see that there will be challenges or dangers in the exit from our current monetary policy, could you tell us what you believe those are and whether you believe we can make an exit in a manner that is not disruptive to our economy?
Thank you, Senator. I think the exit is beginning, or has begun. The extent of the purchases of the Fed, the monthly amount that is being purchased, is being reduced, and conditions for the continuation of that have been described. Could that theoretically be disruptive? Well, you don't have to look at theory. There was the May response, which I must confess I didn't think I fully understood why the markets reacted as if it was a surprise. Been talked about for a long time. But when the actual tapering began, it was handled, it had a much more stable impact. And that seems to be continuing. What I take comfort from, and sort of thinking of all the possibilities, is that the Fed in 2008, 2009 undertook many complicated programs. As far as I know, there were no technical failures in any of those programs, and that's a good precedent. Although here we're relying more. If I'm elected, we will be relying more. In any case, the Fed is relying more on the reactions of the market, and those you have to adjust to as if they're not what you expected, Senator.
Thank you very much. And Dr. Brainerd, I'm going to go to you next. You mentioned the Dodd-Frank legislation in your testimony. I worry that the aggregate impact of the rules of implementing Dodd-Frank will be immense, and that we actually could push some financial companies into basically a regulatory death by 1,000 cuts if we are not careful about the evaluation of cost-benefit in terms of the regulations that are imposed as we move forward. If you're confirmed to the Board of Governors, how do you, first of all, would you agree that there is this risk? And secondly, how would you intend to monitor the cumulative regulatory burden that we are putting on America's financial sector?
Well, Senator, I think the process of fundamentally reforming our financial system is a work in progress. The reforms that were put in place under Dodd-Frank were extraordinarily important, very important to make sure that our largest institutions ran with less leverage, managed their liquidity much more carefully, held a lot more capital to absorb losses, changed their business models, and are fully resolvable without any taxpayer involvement. So I think the pieces of the regulatory reform that are being put in place are each extremely important. But as you say, it's very important for us to be mindful over time of the aggregate impact and how business models change, and make sure that credit is flowing to small businesses, to homeowners, to students. So if confirmed, I would want to be very vigilant, understanding the cumulative impact of these rules, making sure that we are meeting the safety and soundness goals that were set out for us in that legislation. But I presume there will be adjustments, the need for adjustments as we go. And obviously we would expect to work closely with this committee as we monitor and tweak the framework.
Thank you very much. And Dr. Powell, I'm going to ask you the same question that the Chairman asked Mr. Fischer with regard to community banks. The regulatory framework that emerged out of Dodd-Frank has made it increasingly difficult for community banks. And according to some reports, 1/4 of the small banks are now contemplating mergers because they simply can't survive the regulatory environment. Would you agree that we need to address this by being flexible in the kinds of standards we apply to the smaller banks as opposed to the larger banks?
I would agree. Let me say, I believe that community banks, and I have personal experience with community banks providing a special kind of service in local communities that the large national banks are not really set up to provide. It's not a better world as community banks are going out of business. It's a better world with community banks in business. So I think they're very important in our communities, including my own community. So in terms of regulation, what seems to happen is that most of what we've tried to do since Dodd-Frank passed is aimed at the larger banks, but there's a tendency for regulation to run to the smaller banks as well. And so we try very hard to manage that, and we have a special counsel now at the Fed that former Governor Duke was instrumental in setting up, called the Community Depository Institutions Advisory Council. We meet with them regularly to hear their concerns. We've also got a special subcommittee of the board that looks at every regulation and its effect on community and regional banks. So we're focused on this, and it is separately the case that the community banking model is under pressure from national products, product by product, mortgages and all those sorts of things, car loans have become nationalized. We don't want to add any pressure to that at all. We want to not be part of what's putting pressure on community banks if possible.
Thank you.